Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Mr. Manish Gunwani. He needs no introduction. Joins in right now to talk about how he perceives the near to the medium term could be faring for markets. Manish, great having you. Thanks for joining in. I hope all is safe.
Thanks for having me.
The pleasure is ours. Manish, uh, two series or maybe more than that, last 2, 3 months, we've been range bound for the indices at large. And there are multiple views coming about whether the cycle could turn or the markets could turn for the worse, least because of what could happen to earnings, but more because of what could happen to inflation and yields and discounting factors and so on and so forth. Now, too much of confusion out there. Simplify it for us. How are you approaching it right now?
Yeah, there are various risks. So, let me talk a couple of what I don't worry about, what more I worry about. I'm not so worried on inflation in India at least, because I think Indian inflation is driven largely by food and fuel. I think fuel linked to crude prices, at least on a medium term basis, difficult to say that oil will be too much in a 2 3 year time frame from here, because there is technology threats there, whether it's electric vehicles or renewables. I think the OPEC itself wouldn't want, I think, more than $80. So if you take a 2 3 year view, the CAGR in oil unlikely to be very high. Food also, I think agri production is quite healthy. Cereals, I think FCI stocks are very high. So it's more a policy thing than demand supply imbalance, I would say. Real estate prices also, I don't think, given rental yields and all, will go up too much from here. So the inflation is not something, at least from an Indian context, maybe in US where it's driven a lot by wages, which for 10 years have been weak, you could say is a bigger issue. From a structural viewpoint, I'm not so worried on inflation. What I do worry about is two or three things. One is virus, just in case it's a complex subject. You saw second wave come out of nowhere, can't predict. But again, vaccinations globally seem to have worked in terms of death rates and hospitalization. It may not work in terms of cases because you're seeing US and you can get some more cases now. But if you see death rates, they're not going up, which is good, I think. Second is this whole fall in US bond rate. Actually, I think probably the fear is as much deflation than inflation, right? I mean, if you see the US 10-year bond yields, they have fallen 30 40 bits. Now, that's a big liquid market. It kind of determines the risk-free capital of the world, the 10-year bond of US, right? Now, there the fear seems to be lack of growth or lack of inflation more than higher inflation, because otherwise, and it stayed down for 3 4 months. I mean, initially the thought process was very technical because it had gone up a lot. That's why it's corrected. But staying there for quite some time. Now, it could be Goldilocks for India. The low inflation along with higher global growth, which is perfect for any emerging market. So yeah, I mean, base case is not to be too negative given the macro, because everything else seems to be falling in place for India, right? You have high global growth. India, I think, after many years, is running very low nominal interest rates and probably negative real rates, right? You have inflation of 5 6, your short-term interest rates are 3 4, your long, even your 10-year is 6. And then you have pent-up demand, both from a 1 year perspective, from a 6 7 year perspective. Also, it's an economy which has undershot the normal growth rate. So there are a lot of things going for India. Corporate earnings to GDP is quite low. So the earning cycle also looks quite interesting. So I think a lot of us old people are meaning we are benchmarked to certain price to earnings of the market of stocks. I think obviously globally now valuations are seen more in light of the bond yield rather than historic price to earning multiples. So maybe value investors who expect very sharp corrections, they're getting disappointed a bit. But yeah, I think that's the global paradigm. I think you have to adjust to that.
Yeah, so that's okay. Let me ask a follow-up, Manish. So therefore, you made a very important point that a few investors who are kind of anchored to what's worked in the past might get disappointed. So I hear this argument about the market cap to GDP as well so often, and then that it warrants X
Yeah.
versus Y or X kind of a movement. It just isn't coming. And a new breed of investors are telling me that what will happen 1 year, 2 years from now, Neeraj, when the Flipkarts and the others make an entry, and they'll make the PE ratio, so to say, completely irrelevant.
Correct.
So how would you value it then? So that's my question to you then. So how do you construct your central portfolio, Manish, if you will, in a scenario like this?
So I think it has to be a mix of various things, bottom up, macro, thematic. I I'm not of the view that this whole new age business model has to be written off like a bubble. I think the businesses are genuine, right? I mean, it's not like 2000 where for eyeballs you were giving market cap, right? These guys are actually delivering goods and services which all of us use on an everyday basis. So yeah, can they correct 10-20%? Yes. But point is, work has to be done in terms of if let's say 5-7 years you figure out that the profitability is immense, or for example if the ecosystem explodes. See, a lot of times where we go wrong is not that of the existing business the extrapolation goes wrong, the forecasting goes wrong. It is what if an ecosystem explodes or if a management executes better than you think. They do M&A, they go into adjacent business this thing, and in a space which is growing very fast, whether it's gaming or e-commerce or ticketing, online ticketing, whatever. Managements have the opportunity to jump into adjacent spaces or buy something and integrate it well. So if you go back to whatever internet companies which have done well on Indian stock market, or a Google or Facebook, like Facebook bought WhatsApp, Google bought YouTube. Could you have predicted it when you bought them at IPO time? You couldn't have, right? So I think it's a very nuanced debate. Market cap, I think, is a better reflection than price to earning multiple in a lot of these new age business models. So if you have a management where you think potential opportunity size is very high, management is good, I think it's as important to look at market cap versus the potential opportunity rather than be fixated to price to earning or EV to EBITDA. Um, so that is, I think that is my feeling that out of every 10 stocks you see, you could like two, three if you really do a lot of work.
Mm. Well, I'm just trying to understand how difficult a piece would it be for you, say December 2021, Manish, wherein we have a small cap, but a gaming company listed with arguably people say a lot of potential. We now have a food delivery app and potentially two getting listed. We'll have Nika, for lack of a better word, I can't figure out a way to describe it, but I'm just therefore saying the name, and a bunch of others listed. What do you do as in to a portfolio wherein do you carve out a separate scheme, which also you can't, by the way, so to say, but or how do you kind of balance all of that in the current scenario, wherein everybody is now also talking about how India might see a manufacturing renaissance over the next 2-3 years, and there might be tremendous value out there. So what do you do?
No, I think both these are what I say mega trends. One is the new tech models, and two is the China plus one or manufacturing shift from China to India. I think again, as I said, basically, if you see a lot of those segments in, for example, manufacturing like chemicals, pharma, electronic manufacturing, they've done well. But if you see in terms of market cap, I think none of them is a large cap still, right? So that's what I'm saying. That maybe if you're anchored to the historic valuations of a lot of these segments, there's a new segment being added to the theme, right? So suddenly textiles is being talked about, steel spreads. Iron ore may go down, but steel spreads are being talked about as part of this theme, and I think that's true. I mean, it's a fact that India just happens to be in the right place, right time in a geopolitical context, right? Because you have G2 at odds with each other, and obviously for US, India seems to have become a more important player. And these kind of global shift, I mean, if you go back to the 90s, the whole way IT evolved was something similar. It's not that those 100 IT companies were doing very different or rocket science or more kind of work. It is just a global mega trend that pulled them up, right? And the good manager obviously did better. That obviously happens. But the point is, when the telecom links came, when global trade exploded after 1991 liberalization, that is what drove the evolution of the IT industry, right? And it was not so much that the entrepreneurs there knew what was happening. It was just the global tailwind which carried them, right? If you met them in '93, Infosys was a very, very different company from what you see today, right? So these global mega trends, obviously, now there'll be a point where it will become bubble, and it's very difficult to justify at what point that will happen. But I would say that, as I said, look at opportunity sizes, look at unit economics, look at market cap, rather than just take a aggregate P and say market is expensive or cheap.
So when you say look at market cap, how would you approach it? I mean, do you look at, I mean, when does a market cap or a market cap linked ratio look egregious versus when does it look possible?
So frankly, market caps can't give a very, very precise metric. But for example, if I were to take the electronic manufacturing space, right? The Foxconn or Honai is the name of the company that's listed here. Now that gives you a broad sense what is the opportunity size that is possible if things
Got
work.
it.
Not to say that any Indian company will get close, anywhere close, may not be, but it just gives you a sense ki, when these themes explode, what is possible. So I think it's more a directional thing.
Got it. Okay, two questions, and then I want to talk about how good or how tough would it be for your newest offering, which is the Flexicap, because it gives you opportunity to be flexible.
Yeah.
But just two questions. You referred to chemicals as manufacturing stroke, a theme which India is tied in. The China Plus One strategy helps. And I was doing, I mean, it may be completely faulty, but I just doing this comparison of what Dow Chemicals was in 2011, the market capitalization then. And I think some of the largest players, even if they grow 5 times from where they are right now, they'll still be lesser than than market capitalization then. So therefore, while everybody, or not everybody, a few people say that chemicals has already had a green run for the last 6 years, and therefore now the story may be over. Do you kind of second that, or do you believe that it is still getting started?
So just like maybe what happened in late 90s, I think what will happen is 5, 6, 10 companies will still do spectacularly well, both in terms of their own finances and maybe stock prices. There'll be obviously, I think, a lot of companies which will not make the grade in the sense that if you're obviously very commoditized chemical company, at some point this tailwind will run out. But what we are trying to back are managements which can get into adjacent opportunities very quickly, expand their addressable market. Obviously, again, this is not a sector you should buy on a price to earning multiple or EV to EBITDA, purely in the sense that, look, let's be clear about the negatives also. It's a manufacturing sector, so it's a capex heavy sector. Unlike IT, it doesn't generate the kind of free cash flow that IT companies typically do. So there are some negatives because of which the valuation should not exceed a certain level. But the valuation has to be based on a few years out earnings, which you might be approximately right, but that is better than being precisely wrong. That you take a broad estimate that this is a management which is in this chemical process. Now, in that they can add so many products, whatever, that kind of work you need to do, and figure out that they can probably buy something or integrate something, and that has happened a lot. We've seen this week itself that a major chemical company bought a pharma company, right? So those things will happen, right? I mean, and that is where I think some of the 4 or 5 winners will stand out. You hopefully be in one of them.
Got it. Manish, my final question on the sectors before I move to how would you orient your FlexiCap scheme as it is live right now. But my final question is on IT, wherein it's a sector that is proven, it's a sector that has done multiple years of growth. But right now, when I speak to the mid-sized managements, they sound, I mean, they don't sound cocky, but I'm saying they sound confident to the point of sounding almost cocky about what the growth prospects are for the next 5 years. And none of them are cocky, by the way. They're very, very nice people to talk
Yeah.
to. But just that their confidence is sky high right now about the deal wins, about the growth, about everything. Do you reckon that while it's a sector that has run its course so well, there could still be multiple years of growth?
So I think the big return been made, but I still like the sector. One is the sector is on fire, there's no doubt. So if you ask any mid-level good technical guy in, let's say, digital technology, I mean, he has 5-10 offers at his hand, right? I mean, everyone needs talent. So it's more one of those few sectors in a COVID-impacted economy where demand is not the problem. The supply is the problem. At this point, that's a good problem to have. And generally, I've seen Indian managements can manage supply well. Meaning, you will feel that they are under a lot of pressure, but finally deliveries will happen. The work will get the delivered anyway. So I've not been so well. Supply is an issue, may lead to some margin pressure, but that is obviously, as I said, a good problem to have. Second is, I think in this sector, what happened was, if you go back to last 20 years, the industry growth rate, if you see the NASCOM typical numbers that come out on industry growth rate, kept going down, 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 right? So everyone was scared that, from 40 it became 20, from 20 it became 10. So everyone felt, is it a sector that maybe 5-7 years later is it going to 3-5% kind of growth rate? Now I think at least we don't know if it's cyclical or big cycle, but definitely for next 2-3-5 years, it doesn't seem the case that the sectors, going to three. It seems that 10, 12, 9 is there. And when you do that, when you get the confidence that, the sector can grow 8, 10, 12%, and then you compare the free cash flow yield versus the FMCG, some of the pharma names and all that, it does stand out still, right? I mean, again, I mean, just we were discussing chemicals. Chemicals, interesting space. But if you see, because it's a manufacturing space, or if you see auto exporters which are manufacturing, if you see on a free cash flow basis, the IT sector still standing, right? And also sector has got some technical support because the big boys are buying back stock. So the supply is actually going, there's not too much of new supply or new IP. So I think, yeah, it's just like next 2-3 years, it's now more a compounding kind of re-rating. Obviously looks difficult from here, but you never know. But yeah, I mean, if you don't look at on historic price to earning multiples, but look at on free cash flow yield across the market today versus growth. I think now you can say steel has better free cash flow yield, but we all know things can go
Yeah,
wrong.
change
Along.
completely. Yeah, that's true.
Yeah, but among the more structural sectors, it's among the better free cash flow yield right now.
Thanks, Manish. Thanks for that. Final question. So, therefore, if there is so much of opportunity, how are you going about structuring your Flexicap offering? And there are a bunch of things out there. So, I mean, is yours quote unquote different, or you don't need to be different? You just need to perform well.
Yeah, so obviously with defined category, there is limited space to be radically different. But what we're saying is basically on two parts. That one taking higher active share. That is, so if you see in this category, a lot of funds are large cap dominated, low active share. Active share is basically deviation from benchmark. What we're saying is we will have more mid and small cap to start with, and over a cycle now. Very few points we might be very large cap dominator only because if we believe mid cap has reached a frothy stage. But what we feel that the flexicap category allows you to have some aggressive stock picking. So allows us to use our mid and small cap research. So if you see our small cap and mid cap funds are among the leaders in their categories. So we think we have a good research team. I also think that the space will be very vibrant because a lot of the new age business models are also funded by private equity, which will need an exit. the large cap space, last 7-8 years, India has grown slowly. So it's become very defensive. Weights of FMCG IT have gone up. I think mid and small cap space is going to be very, very interesting because we live in an age of disruption. So whether these mega trends like manufacturing, you will see a lot of companies come into the picture. Even existing companies, if you see a lot of the existing companies which have demonstrated ability to execute well on the tech side, whether it is a bank or a hospital, you've seen that the re-rating relative to the sector is also quite high.
That's true.
So I think it's a very interesting space, the mid and small cap space. So we think that our Flexicap fund will have more of mid and small cap versus others. And to start with, maybe like 50-50, as in 50 large cap and 50 mid cap.
Exciting times to be launching such a scheme. So wish you all the best for that, Manish. And thanks so much, more importantly, for all the wisdom that you shared today.
Thank you. Thanks for having me.
Now the pleasure was ours. And viewers, thanks for tuning into this edition of The Talking Point.